The soft landing narrative taking shape on Wall Street. Still uncertainty surrounding the growth of the U.S. economy, remaining a mixed picture following a fresh set of economic data this week showing that the labor market is rebalancing and pricing pressures cooling off just a bit. Holiday sales warnings from retailers, though, also emerged as a slew of companies reported earnings this week. Walmart, the nation's largest retailer, saying that deflation could be coming relatively soon. So what does all this mean for shoppers this holiday season? What does it mean more broadly speaking for the market? We want to bring in Ben Emmen, Senior Portfolio Manager and Head of Fixed Income and Macro at NewEdge Wealth. Ben, it's good to see you here. So your takeaway from the action that we saw this week in terms of what we're hearing from the retailers and also the new econ data that we got out that really started to, I think, sort of reinvigorate this conversation that we're starting to have about a soft landing being back in the picture.
Yeah, I think that's entirely the right way to describe it, because what happened with that CPI report was that we saw items like rent really breaking down, and that's about the pandemic. Finally, we're normalizing out of that shock. And, Powell and the Fed have been saying, once that rent starts to decline, we really feel that we're getting on track towards the target. And I think that's what the market took on, saying, okay, Fed, you are, quote unquote, done. You're not maybe cutting rates, but you definitely don't have to hike rates. So that was the first relief. And I think the second one was that if you get a Walmart CEO coming out and saying, hey, guess what, there's going to be deflation, that is a narrative that does struck a chord with markets. Of course, he's making, I think, a marketing campaign to get people in the store. But I think for the bond market or the stock market, it was like, deflation is something that was from pre-pandemic. That was a risk at that time. Coming from a major shock of inflation towards eventually a deflation, that's being discounted. I think that's why you're seeing this major lift in markets.
So based on the readings that we got this week, does that signal to you a Fed that is going to keep rates steady for the remainder of the year and potentially, based on from what we've heard from some economists, perhaps even think about a cut at the midpoint of next year, maybe later?
So I think the framework is this, So yes, they don't have to necessarily hike in December, barring that there's not other data that's going to be suddenly surprising, because who knows, right? But and then the Fed has put out this idea to say, if we keep this funds rate at 5.5 and the inflation continues to decline slowly, the Fed funds accounted for inflation, as in the real rate, gets higher, it starts to rise. Now, after the CPI report, I calculated that the funds rate went from 2% real to 2.25% real. Ironically, so the Fed gets actually more restrictive in real terms, and markets are lifting up. But for the Fed, this means that if they're getting a real rate, say, close to 3% next year, there's quote-unquote room for them to normalize that 5.5 funds rate, say by 100 basis points or 50 basis points down. That's in their forecast now. I think that's likely, but it's the word normalization. That's what Daly put out there, that's what Barkin put out there. It's not easing. They just simply say we have a restrictive rate that's high. We can normalize it a bit down, given that inflation is getting closer to the target. I think that's what markets understand. So it's not necessarily a negative, because if you were cutting rates quickly, that would mean you're in a downturn and you're getting a very different picture. So I think, again, this is all playing into this current narrative in the markets. Who knows next year, but for the moment, for year end, that's very positive.
But what do you see the upside looking like from here? Because you have the S&P coming off its highest close since the beginning of September, the NASDAQ coming off its highest close since the beginning of August. Is there much room to move to the upside between now and year end?
From a technical perspective, yes, it is. Because there's this positioning out there that I think some of the other guests earlier spoke about too. In stocks and bonds, there's still a fair bit of short positioning. And that pent-up covering of shorts, so to speak, is really substantial. It can be in the hundreds of billions of dollars. And it is all about sentiment, really. So if you're getting technical levels triggered, say on the 10-year we're breaking below the 4.25, and on the S&P we're breaking above 4,600, that sort of ideas, you're getting suddenly this rush, and you get momentum players come in the market. So these are like hedge funds or these commodity trading advisors, CTAs, they call them. And I think that's all setting up for this year-end quote-unquote rally. Again, things could change. We could have other negative news come in, but technically speaking, it looks like that setup.
Is a continuing resolution that we'll have to once again consider in January and then again in February, is that part of kind of the negative considerations that are still on the table out there for the markets?
Maybe not so much at this moment, because I think what markets have concluded is like, no matter what happens in an election year, we just cannot shut down the government. So it has no effect on the economy. But what is happening is that within Congress, as we talked last time, clearly there's a view developing, I think bipartisan view almost, like we do got to rein in the spending at some point. Right? We're just overspending. That will be the big change for the economy, because a lot of the growth that we had this year was fueled by fiscal spending. I would say almost the majority of that, meaning aside from consumer spending, it was really the investments that we've made in the economy. But the strategic view of that is that it does lead to productivity gains that are picking up, and that's important, I think. So it's a bit of a delicate balance here. If they don't slash spending as much as they did back in 2011-12, we'll end up with an economy that's going to be stronger next year, meaning no recession, 2-3% type growth rate. If they do end up with this sequestration that you saw in 2011-12, then you're getting a very weak economy. I think given the election year, I think the former is the more outcome of a stronger, like 2-3% economy.
Interesting. Ben, great to have you here with us in studio. Congratulations on,
Yes.
we had been talking about this for weeks, if not months, leading up to the New York City Marathon. Your training, we had even done one of our teases, our packages around that, and the regiment that went into it. Congratulations on finishing the race.
Thank you very much.
Absolutely. Ben Emons, who is the NewEdge Wealth Senior Portfolio Manager and Head of Fixed Income. We appreciate you joining us here today.